Hello everyone, welcome to Crypto Basics Coach podcast. I'm Marco. I'm here to help people navigate this topic so as to benefit from the opportunity this new technology provides and not get distracted or put off from the nonsense there is out there about crypto. Anything and everything presented and discussed, whether here or in our sessions, is of an educational nature and should never be taken as financial advice. Always do your due diligence and consult professionals before making any final decisions. Episode 12. Hi guys, hope you've been well. Hope you had a good week. This week's topic that I'm going to cover is some of the products that I'm starting to see being developed, and I was expecting these sorts of products probably 6 months ago, and there's obviously more to come. In a previous episode, we discussed the different ways that you're able to earn yield in the crypto industry. It usually involves yourself getting into the nitty-gritty, getting into DeFi. Now, you're going to need some skill and some education around that. And of course, will everyone do this? And the answer is no. The majority of the population aren't going to go to the levels that some of us participate in. They're going to opt for other alternatives that I'll get into in this particular episode. For the majority of the populations, the institutions are going to create the products. So what will happen is that through familiar platforms like a shares trading platform that you might be familiar with, or a retirement platform you might be familiar with, or through financial advisors, managed funds, the use of ETFs, exchange traded funds. The majority of the population will no doubt get involved and earn yield and some sort of return from crypto using the traditional methods, which are probably still another 3, 6, 9, 12 months away, but they're definitely coming. No two ways about it. And I'll talk about a couple that are already here. So if we keep this simple and we just use level 1, level 2, level 3, level 1 is essentially where you would interact directly with DeFi. And as I've mentioned, that involves a fair bit of learning, a fair bit of skill. It's not impossible, but it just requires more time, more effort, and it's not going to suit everyone. Level 2. Level 2 is where you're going to be interacting with a third party, someone who has gone and developed an application on within DeFi or an offering, similar to Axelar and Midas. They come to mind. They've just recently launched a product in the last month where you're essentially able to put your funds into a product that then goes off and creates yield. And what's interesting about some of these products is that it's a way of putting your crypto to use. However, some of the returns are not necessarily generated by crypto DeFi. The returns are generated by traditional finance, and it depends on the product that you get involved in. But the key point here to remember is that it involves third parties, meaning you do have a certain amount of third-party risk. So who do you choose? How much do you allocate, etc.? And then level 3 is going to be where you're going to be investing through institutional products via the traditional means that I just mentioned before. Now, the returns are going to vary between level 1, 2, and 3, but you need to weigh up the pros and cons. You need to weigh up your circumstances, how much time you're wanting to spend. Needless to say, if you're doing it yourself and you know what you're doing, you're probably going to make a better return. But sometimes that's not warranted versus the amount of time and effort that you need to spend. Depends on where you're at in life. Some of us are more interested in enjoying retirement than becoming full-time traders, so to speak. So you'll find your balance. What's important is that you actually understand all 3 levels and then you decide accordingly. Again, I'm big on education. So educate yourself on the 3 levels. Doesn't mean to say you're going to use them, each of them, or you might. But the point is that you're then able to discern between one level and the other, and you make the appropriate decisions for yourself. So let's have a look at where we are today and what I've seen, particularly in the last 6 months. Now, level 1, with regards to you getting involved in DeFi, this definitely requires a fair bit of training and a fair bit of learning. The whole conversation around DeFi is best left for our private sessions. There's some courses I can refer you to. There's definitely some things that I can help you get set up and clarify and act as a sounding board and to give you some ideas of what to expect. Okay, but level 1 is not something I'm planning to get into in this call. Level 2 still requires some training and some learning because, of course, you need to understand what these third parties are offering, how perhaps the product is built, what risk you're exposing yourself to, what risk you're exposing your crypto to. As you learn more about the industry, you'll understand what I mean by my next comment, which is that sometimes you'll be moving your crypto off-chain into someone else's custody, and sometimes you're actually able to leave it on the chain where the native asset belongs. And that carries two different risks doing that. So you do still need to understand how is the offering bolted together. But the point is that you're going to pick a third party and you're able to go off and start generating some yield. And the yields that we're talking about here, look, just simply, let's just group them around 5% to 20% a year. Okay, they'll vary, and there's more and there's less, but let's just use that as a bit of a starting point, that you're talking about yields of 5% to 20% a year. And let's go through some of the products that already exist as of today using third parties. You can loan you can loan against your crypto, meaning that you're putting your crypto up as a collateral, and you're then able to borrow perhaps a stable coin, perhaps some other asset. You're then able to go off and do whatever you want. If it's a stable coin, you potentially could cash that out for cash and then go and buy a business, other yield generating opportunities, whatever you want to do. But you're basically putting up your crypto as collateral. You're able to lend out your crypto, meaning that you can put it onto certain platforms or within certain products where you're going to receive a return. Typically, your crypto is going to be lent out for leveraging activity that other traders are doing, and you're going to make a yield for that. You may potentially at the moment put your crypto into vaults, where you're essentially putting it into an offering where the third parties are then borrowing and doing other things against that, but essentially they're going to then return you a yield by doing some things on-chain and some things off-chain. Okay, I mentioned Axelar and Midas. That's a mixture of traditional trading activities and also crypto activities. So you're putting it into an offering that someone else is running. Think of them as a managed fund of sorts. And again, you need to understand what risks your assets are taking, what sort of returns, what happens, like for instance, happened 3 weeks ago when the complete bottom fell out of the market and all the people that were leveraged took an absolute bath. Okay, so you need to understand those sorts of things when you're putting your hard-earned crypto into these sorts of vaults and understand what the repercussions can be. Or you can put them into liquid staking, where essentially you're placing your crypto into an offering. You then get back what's called a liquidity token that you're then able to go off and do other things. And again, a lot of these are becoming very productized by these third parties, where you don't have to go onto separate platforms, log in, transfers, keep an eye on it, select liquidity pools, etc., etc., etc. There is supposed to be, similar to the traditional products, you place your crypto into an offering and someone else in the background is going off and doing all the work to generate you the yield. And so over the last 6 months, I've been seeing a lot more of these products where they obviously are less hands-on. You still need to understand what's going on, and you can then take advantage of them. I'm still sitting tight and waiting for a bit more maturity in the market. You may be different, and you may decide to place an appropriate amount into them as we speak. And then the level 3 ones, where the institutional products, well, we've already seen a Franklin Templeton product. Franklin Templeton is a very well-known funds manager, finance company over in the States. They've already created a product on the Stellar network. That's XLM. What else is there? Well, right now, the big news has been that in the last 12 months, we've had Bitcoin and Ethereum ETFs, exchange-traded funds. The big news in the last probably 30 to 45 days has been that staking for Ethereum has been made available, which means that these funds are now starting to earn yield. They're not just a way of holding the underlying asset, but there's actually yield now starting to be generated. That's been passed and accepted by the SEC. That's the regulatory authority over in America. And in the last, 2 weeks, we've seen ETFs for Litecoin, Hedera, and Solana. And there would seem to be a couple more to come in the next few weeks. So as you can see, the traditional TradFi companies, the incumbents, they've found a way to make money with crypto, and guess what? Now they're all pro-crypto. Now there's a coincidence. But in any case, they're the more traditional ways that you're able to start investing, start taking advantage of yield-generating products. And so if you're, wanting to have a bit of a hands-off approach, but go through your traditional sources, there's just some And guys, there's a tidal wave, an absolute tidal wave of these sorts of institutional products coming our way, especially once the Clarity Act in the States is passed. You will see the advisors licking their lips, being able to go out to all their customers now, offering them traditional products that are essentially backed by crypto, and the yield generation is coming from crypto as well. So there's level 1, level 2, level 3, roughly explained. There are more products to come, and there are products at the moment almost coming out every week from some company doing something that packages a crypto solution and creates an offering for you. Now, what I wanted to do before I get into the homework is just make a small announcement, which is that as of this weekend, I've now gone live on TikTok and Instagram as well. So if you're sick of my voice and you'd like to see my face, I'll be on there and trying my best to provide some quality content on most days. They'll be short. They'll be nothing like this podcast. The long version will still be here, and nothing really changes. The idea is, hey, if you need my services, if you're looking for a hand of navigating these markets, you know what to do. Reach out to the website and book your sessions. Now, last week, we talked about the homework being bailouts versus bail-ins. I hope you've looked into it. No doubt you've been a little shocked at what's occurred and what's happened, and the potential risk that our money is keeping it in the banks, and what could happen. Doesn't mean it will happen, but what could happen if the banks were to go under. And it's worth noting, guys, that here in Australia, we have a fairly robust banking system. This is not about, creating, hysteria and so forth. This is more about being practical and understanding what's going on. Here in Australia, in 2008, our banks were fine. Our banks are not typically as leveraged as some of the overseas jurisdictions are. I wouldn't expect our banks to fall over because they typically are more conservative, but it is still important to understand the landscape and what is going on and the mentality of institutions, incumbents and government. That's important. Okay, so hopefully you've looked into that and you know what I'm referencing. This week's homework is about the central banks. And the question that I have for you is, why have central banks been buying more gold in the last 5 years than in any other time in human history? Okay, that's not a sensationalizing statement. It's true. In the last 5 years, why have they been accumulating more gold? What are they expecting? Why are they doing it? What position does it put them in? And more importantly, I think it's safe to say that we can call central banks smart money, and you know what the ethos is. Okay, follow what the smart money does. Don't listen to what they say. Watch what they do. Okay, so go and look into that. That may very well tell you what the plan is and what they're getting set for, and perhaps what you should be doing about your finances to also get into position and take advantage of what's coming. Until next week, you guys all take care. Hope to see you again. Cheers. If you found this information helpful and are interested in a more hand-holding approach while navigating this complex industry, please visit cryptobasicscoach.com, that's basics with an S, and book a session. The first 30-minute session is free, and we can get to know each other, talk about what your aims are, what you're looking to do, and how I might be able to possibly help. I've helped people get started, set up exchange accounts, wallets, DeFi platforms, and general knowledge. Look forward to speaking with you. Cheers.